Hello everyone, welcome to a new video. In this video, we are going to see about the second chapter of the book Stocks to Riches written by Parag Parikh. Hope you had a lively book reading experience in the first video. This video is gonna be a similar kind of video and we are going to look into a second chapter. We know in this book there are 11 different chapters, and in the last video we have a summary of first chapter, and in this video we are going to see a summary of the second chapter. The second chapter is nothing but investment strategy, where Parag Parikh talks about the investment and speculation. First of all, let's see the difference between investment and speculation. Investment is an act of faith, a willingness to postpone present consumption to save for the future. In today's world, we will be saving for tomorrow's. That is investment. Speculation is nothing but we buy stocks in the belief the prices will go up and we will be making a profit. This is called speculation. This is a basic difference between investment and speculation. So right now we go into a cash flow. First topic of the second chapter, cash flow. Cash flow. Cash flow is nothing but the dividend payouts of the company, which arise from the company's earning potential and are possible only when the company has a positive cash flow. What does this mean? It means whenever the company has a profit, it divides a part of its profits to its shareholders in the form of dividends. So, for a company to have profits or to have dividends in another way, it need to be said that the company should have strong fundamentals of the company should be very strong, and the sustainability or robustness of the business should be very good, and it should hold a very strong position in the competitive marketplace, and more than ever it should have an excellent quality of management. If all these things fulfills, then only the company can able to generate a positive cash flow and able to give us a dividend. Now let's go into a second chapter, capital gains. So what do I mean by capital gains? Parag Parikh says when the stock goes up in value and one sells at a profit, the gain he got is known as capital gains. Example, let's see this chart. This is the stock price of Infosys actually. So this is stock price of Infosys and 1 month chart. Here let's assume if we buy at a price of around 130 here, and if we sell at the price of 432 here, so buy price equal to 130, sell price equal to 140. So our capital gain or profit is 300 rupees for one share. Imagine if you have 1000 shares, so profit will be 300 into 1000, which is nothing but 3 lakh rupees. So this is capital gains. Let us erase this thing before we go further. So the third thing is the case study of Infosys. So let's see what Parag Parikh discussed in the case study of Infosys. Case study involves two cases, case 1 and case 2. In case 1, you can see around 1999 the stock price of Infosys is 10 rupees, and it has taken massive growth to around 160 rupees in a span of 1 to 1.5 years. So many people, this is the time during the technological boom or IT boom we can say, and many people thought it keeps on going further, but the experts know that the market value of the company is getting raised at an exponential rate, and it can't able to sustain its growth, because if it able to sustain this kind of growth for a period of 5 to 10 years, then the market capital of the company would be higher than the GDP of many countries, which is highly impossible. So actually they predict that it can't able to sustain its growth. Rather, it can make a sideways growth from then, sideways or downwards growth. And actually, the experts were right. Example, it reaches a maximum of 200 rupees, and after that, from 2001, it started falling. Example, you can say not just for a period of time, for a long term. Example, from 2001 to 2003 or 4, it never again reached the same price which I earlier reached. So, investing at right stocks, from this case study, we can understand that investing at right stocks is very important, but it is very important that we should invest at the right price. Coming to the fourth chapter, the law of form. So, the law of form says that getting carried away by the greed of quick returns ultimately destroys wealth. In order to build wealth, we should not focus on the quick returns. How we can prove this? So let's see this with an example. Example: when we get a egg from an hen, we can able to sell this with a profit of ₹10. But if we wait with patience, then it might give rise to a chick, which can go for ₹25. But still, if you wait with patience, you can go to a half-grown hen, which can grow up to ₹25. If you wait further, if you wait till it goes to a fully grown hen, then it might go to around ₹200. But if you allow it to make more eggs, then you started generating wealth actually. So a couple of hens can give n number of eggs, which you can keep on selling and gain profit. This is the way of generating wealth. Similarly, in stock market, when the stock goes up, we can sell and make a quick returns, or else we can hold on with patience. Then it can help us to generate wealth by giving us dividends and a greater percentage of capital gains. This is the law of form which Parag Parikh talks in his book. So, a good strategy. The next chapter is a good strategy. What is a good strategy? Let's see first of all what's the difference between a strategy and the speculation. A strategy is nothing but we buy stocks or do something with fundamental knowledge. We understand something, then we proceed again. In the case of speculation, we don't know things, but with hope or with someone's advice, we just enter the thing. It is called speculation. Next in strategy, investing at right levels. Yeah, investing at right stocks is very important with fundamental knowledge, but investing at right stocks at the right levels with patience is very important. It may be we can even invest in bear markets so we get at a low price. In case of speculation, investing at a peak price or in a bull market with greed, where investing in with good stocks in peaks doesn't help us to gain returns in a better way. And the third thing in strategy is investing in parts or doing SIP. If we have 1 lakh rupees, it's better to split 1 lakh into 4 parts and invest 25,000 in at the time instead of investing lump sum at one go. So the next point is risking the capacity of taking losses. Yeah, though investment gives us great returns in longer run, for a period of shorter run, there is always a risk associated with it. So it's better to risk the capacity of the losses which we can able to endure. Unlike risking beyond the capacity of losses, will destroys not only wealth, it destroys our profit and makes us to lead into losses also. The next topic of the second chapter is risk reward balance. Yeah, there should be always a balance between risk and reward. Yeah, we are looking for profits, but there is always a risk associated with it. So it's better to have an equal or more reward. Example, in this graph, we can say this is a graph of risk and reward. Yeah, it's better to be in the center, like this line, having a balance between both. But it's more advantageous if we able to go the upper area, where we get low risk but high reward. Everyone wants this, but many people don't know how to do this. So the way doing this is by investing in quality stocks, we can able to neglect risk, and by buying stocks at a fair or low price, we can able to get high rewards. By adding more positions in bear markets, we can able to had we can able to get high rewards. So by investing by SIP method instead of lump sum, we can able to reduce our risk. By investing in different sectors of stocks or mutual funds, we can able to reduce our risk. So by doing these things, we can able to reduce our risk and increase our returns. So the next topic in the second chapter is nothing is right or wrong. So after saying all these things, Parag Parikh also says nothing is right and nothing is wrong. Meaning, from now we kind of get a knowledge that long-term investing is good, but short-term speculation is bad. But he also says it may not be a case always. Example, he takes two cases. One is, in both the cases, we are going to see the trend of Infosys. Let's assume someone buys Infosys stock in 2000, around 2000 at the price of 142. So he make an entry here. Let's assume. But on the other hand, let's run this for so you'll have an idea. Yeah, let's assume someone makes an entry here at 142 and sells at a price of 4112. On the other hand, a different person makes an entry here in 2009 at the price of 130. So it's kind of he got a same stock at the lesser price in 2009 and he also sells at 432. So this short-term speculator who stays in the market from 2009 to around 2011, so in the span of 2 years, his returns is even higher than the person who stays from 2000 to 2011. So a 2-year speculator just can able to get the same kind of return of a 10-11 years long-term investor. Yeah, it happens in stock market. So this time, if someone is a short-term speculator, he might have a law for the long-term investor, right? So now from this idea, we might go back to thinking of that long-term investing might be bad and short-term investing speculation might be good. Yeah, for this case it's right, but the problem is how many times we can able to time the market such precisely. That's the issue. Yeah, we can able to do a couple of times, but in the longer run we can't able to do more times. If this we can't able to exactly catch that trend more times. It's better to be a long-term investor who do short-term speculation at times. So let's erase these things, and these are the chapters which he discussed in the second. These are the topics which he discussed in the second chapter, and the last topic is the reference. So the last topic of the first chapter is references, and here he discussed some of the reference. He referred some of the references which helped us to make this chapter, and hope this video was useful for you. And if you like the video, please hit the like button and please subscribe so that you can watch more videos of this kind. Until then, thank you and bye bye.